Is right now a bad time for a Roth conversion? It's no secret that financial markets are experiencing quite a bit of turmoil. And if you're a regular viewer of the Safeguard channel, you know that we're big proponents of taking steps in every market cycle to move your retirement forward. There are always opportunities that are available to be seized. One of these opportunities is performing a Roth conversion while the market is down. And here's why this can be so powerful. Let's say that at the beginning of the year, we have a traditional IRA that has $1.2 million in it, and we know that we want to perform a $100,000 conversion throughout the year. And let's say there's no investment growth throughout the year. And so we perform a $100,000 conversion. And so at the end of the year, we have $1.1 million in the IRA and $100,000 in the Roth IRA. Let's look at a slightly different example, and let's assume our investment portfolio is down 20%. So our $1.2 million traditional IRA has turned into $960,000. So now when we perform that $100,000 conversion, we have $860,000 in our IRA with $100,000 within our conversion. Now, nothing special happens here until our portfolio recovers. So let's assume that our portfolio recovers back to that starting $1.2 million value. Well, because we performed a conversion at a discount, that $860,000 in the traditional IRA will have grown to $1,075,000. But now what we have in our Roth conversion will have grown to $125,000. So we still have the same $1.2 million that we started with, but now we have a much more favorable tax environment in terms of where our assets are in each given retirement account. And this is powerful for two reasons. The first is that we pay conversion taxes on a smaller amount on that $100,000, but after the recovery, we end up with $125,000 within that Roth. Also, based on the timing of that conversion, after the recovery happens, we are able to get more out of that conversion, all things considered. We now have less within our traditional IRA, so we got more out of that conversion when we performed it at an opportune time. So market volatility can offer an incredible opportunity to perform some specific strategies. So why then would right now be a bad time to perform a Roth conversion? I've heard quite a few times over the last couple of weeks from new families that our team is meeting with that their current advisor is recommending they don't perform a Roth conversion right now. The idea here being the market is down and could fall much further. And if that happens, a Roth conversion on paper starts to look a little bit worse. Using our previous example of performing a Roth conversion when our investment portfolio is down 20%, if our investment portfolio continues to fall, well, now it looks as though we've paid more in Roth conversion taxes to end up with less within our Roth account. This is not a great idea, all things considered. But the mistake these advisors are making is assuming that we know what's going to happen next within financial markets. And by the way, even if we knew the market was going to fall further, I would make the case a conversion would still make sense. For instance, if we knew with 100% certainty that the market was going to continue to fall, no logical person would stay invested in the market. In fact, they would probably invest in instruments that do well during market declines, thus making that conversion still make sense because the conversion would still increase in value. But again, the problem here is we don't know what's going to happen next. So rather than making a fear-based decision, we should make a data-based decision. Ultimately, to perform a Roth conversion when the market is at a decline, we need to believe two base principles. The first is we need to believe that the market is going to recover at some point in the future. The second is we need to be long-term investors. As I hinted at before, if we don't believe that the market is going to recover, well, we shouldn't be invested in the first place. Right now, the market seems to be in quite an aggressive decline, but market downturns are quite common for the stock market. On the screen, you'll see a table since 1928 that shows intra-year declines within the stock market. And what you'll notice is there are a lot of times that the market is down significantly in the middle of the year, only to end up quite a bit higher by the end of the year. And even if you believe the market is going to fall further from here, at what point is the right time to layer on that Roth conversion? We know that a Roth conversion at a discount makes sense. The only argument you could make is the timing of that conversion. So the deeper the discount, the better that conversion. So converting when the market's down 30% is better than converting when the market's down 20%. So if you believe there is going to be a steeper decline, at what level will you be ready? But be careful here. If you're waiting for the proverbial fat pitch, you're going to miss a lot of singles, doubles, and triples that can improve your retirement. For instance, if you were waiting for the market to hit a 40% decline in order to perform that Roth conversion at a discount, over the last 70 years, there would have only been about 3 points in time where you would have hit that given level. If instead you performed a Roth conversion every time the market was at a 20% decline, there would have been more than 10 opportunities to perform a conversion at a discount. And so sometimes taking a shallower level can make more sense because of the frequency of being able to perform that discounted conversion. And yes, sometimes the market fell further if we're using a more shallow discount level. But we need to be willing to give up perfection in retirement planning for good enough. Perfection is a fallacy when we're dealing with uncertainties. We need to shift our thinking and think as a long-term investor. The money we're converting is money we don't need in the short term anyway. The reason I know this is because if we're performing a conversion at a discount, we're performing a conversion of stocks. Well, we shouldn't have money invested in stocks that we need for income over the next year, 2 years, and so on. And so this is money that has a longer term horizon by definition. Also, in most cases, we wouldn't be performing a Roth conversion for money that we need in the short term anyway. This is longer term money that we're trying to avoid things like RMDs, like tax hurdles down the road. And that Roth converted bucket is likely a bucket that we're not going to be using for quite a while. So it has a longer time horizon on that money anyway. But if you're still not convinced, there is a middle ground. So as humans, we're drawn to binary decisions. It's either all in or all out. We either perform the Roth conversion or we don't perform the Roth conversion. But life doesn't have to be a yes or no answer. Let's say that we have a $100,000 Roth conversion that we want to do for the year, but we're nervous about doing a large Roth conversion when the market's at a decline because it could fall further. Well, what we can do is we can break up that given conversion and start when the market is down 10% and then layer on additional conversions at every subsequent decline. If the market then recovers at any point, we can leave the rest of the conversion that we missed out on until the end of the year, so we can nail that tax target that we were ultimately trying to hit. Now, this is probably not going to be the most optimal on paper, but remember, when we're making retirement decisions, we need to be thinking about what's optimal from a numbers standpoint, but also what's optimal from a peace of mind standpoint. And so this is better than performing no conversion at all and will allow you to sleep a little bit easier at night. The core takeaway here is we need to be fighting the urge to simply sit on our hands during this market volatility. I find this is a trap that a lot of retirees as well as advisors fall into. And it can be nerve-wracking to see investment losses within your portfolio. That's completely understandable. But also understand that there are steps that we can be taking in every market cycle to move our retirement forward in the right direction. The topic of Roth conversion timing is an extremely important one that is rarely discussed. Well, just how important is Roth conversion timing for your retirement? Click on this video right here and see. We discuss 5 different Roth conversion timing strategies that deliver wildly different outcomes for retirees. The best strategy for your situation may be quite surprising. Always remember, you don't need more money, you need a better plan. Thanks for watching.